Okay, so we have thoroughly explored price elasticity. Now let's turn to elasticity in areas other than price. The concept of elasticity really extends beyond just the price and quantity that we've been looking at. Elasticity provides a versatile framework for analyzing responsiveness in markets in many different ways. So understanding how one variable affects another in the marketplace is really important, and elasticity helps us to do that. So learning outcomes, we want to be able to calculate the income elasticity of demand and the cross-price elasticity of demand, calculate the elasticity in labor and financial capital markets through an understanding of the elasticity of labor supply and the elasticity of savings, and then apply price elasticity concepts to real-world situations. So elasticity measures the responsiveness of one variable to changes in another. Those variables are not exclusive to price. Elasticity can analyze income changes, cross-product relationships, labor markets, and financial markets. So there's key types of elasticity here. There's income elasticity of demand, cross-price elasticity of demand, and the elasticities in labor and financial markets like we just mentioned. Income elasticity of demand is the percentage change in quantity demanded divided by the percentage change in income. For most products, most of the time, the income elasticity of demand is positive. That is, a rise in income will cause an increase in the quantity demanded. So we break these into two different categories of products when we look at income elasticity of demand. We look at it in terms of normal goods, which most products are normal goods, and inferior goods. Most products are not inferior goods. Normal goods have a positive elasticity, like luxury cars or organic food. Inferior goods have negative elasticity. So, like generic products, cheap wine, fast food, things that if people were to have more income, a higher income, it's actually going to shift demand more for normal goods over to the right so that more is being demanded of those nicer products, those normal products. And a higher income means you'll buy less. You'll have a shift to the left for demand for those inferior goods, like the generic foods, the cheap wines, the fast foods. You can afford nicer things, so your demand is moving to those nicer things as your income increases. Cross-price elasticity of demand is the percentage change in the quantity of good A that is demanded as a result of the percentage change in the price of good B. So this looks at one product versus another product that may be related to one another. How does a change in one product affect the demand for another? Okay. So the categories here aren't the same as normal versus inferior goods, but we still have two categories of goods that we look at. We look at substitute goods and we look at complement goods. Substitutes have a positive elasticity. So this is like tea and coffee. Okay, if the price of coffee goes up, more people are probably going to buy tea and less coffee because tea is a good substitute for that. They're not complementary because you don't want to drink your cup of coffee and your cup of tea at the same time. You generally would do one rather than the other. And so we think of these as substitutes. Complements, on the other hand, have negative elasticity. So think about like peanut butter and jelly or peanut butter and bread as the example here. You tend to buy those things together at the same time. And so if there was a big increase in price for peanut butter, well, bread and jelly and other things that use peanut butter as an ingredient are probably going to suffer as well. There's going to be a negative elasticity effect there. Wage elasticity of labor supply is the percentage change in labor supplied divided by the percentage change in wages. So here, think about like teenagers, they have a higher elasticity because they're going to be more sensitive to wage changes. If they can find a job that's paying $10 an hour, maybe they'll take it. But if they can find a job paying $12 an hour, you better believe a lot more are going to quit that $10 an hour job and go get money for $12 an hour. They're not. That's a big increase for a teenager. On the other end, a prime age adult, like someone like me, I'm not really going to change jobs over a small increase in pay. I have a lower elasticity. I'm less responsive to wage changes. So the other piece to this is the wage elasticity of labor demand. And that's the percentage change in labor demanded divided by the percentage change in wages. Low-skilled service workers, like fast food employees and retail cashiers, they're going to have high elasticity because employers are highly responsive to wage changes in those jobs, and they can just substitute that labor with automation or reduced hours. They can easily add self-checkout kiosks these days. On the other end, though, doctors and people with specialized professions have a low elasticity because demand is going to be relatively inelastic. Their skills are still essential, and there's fewer substitutes. It's harder to replace them. Now, when we look at elasticity in the financial markets, we have what's called interest rate elasticity of savings. And that's the percentage change in the quantity of savings divided by the percentage change in interest rate. So elastic savings increase substantially when you have higher returns. And so when interest rates go up, if people have elastic savings, they tend to put more money into their savings account to get those higher returns from the interest rates. Inelastic savings responds minimally to interest rate changes. So you may have some savings in your emergency fund. Well, you don't want to take your emergency fund and start to invest that or put that into a money market account where it's kind of harder to get. And you definitely don't want to buy a certificate of deposit. Even though you can get a higher return, that's your emergency savings you need quick access to. So you're less likely to put that into an interest-bearing account. Even if interest rates change, there's just less elasticity to that. So now there's also the interest rate elasticity of borrowing, and that's the percentage change in the quantity of borrowing divided by the percentage change in interest rate. Borrowing is typically more elastic in the long run than maybe in the short run, but interest rate definitely has an effect on how businesses and how individuals borrow money, and you have to be looking at that more as in long term. So I want you to think back to Netflix. That's what we opened this chapter with. We talked about Netflix in the introduction. So how did the 60% price increase in 2011 end up working for Netflix? It was pretty bumpy, right? So before the price increase, there were about 24.6 million US subscribers. Now remember, this is back 2011. After the price increase, 810,000 customers canceled their Netflix subscriptions, dropping the total number of subscribers to just under 24 million. Fast forward a couple of years to June 2013, and there were 36 million streaming Netflix subscribers in the United States. They were phasing out the DVDs and going all in on streaming. This was an increase of 11.4 million, this was an increase of 11.4 million subscribers since the price increase, but the average per quarter growth was only about 1.6 million, whereas the growth in the is less than the 2 million per quarter that Netflix was experiencing prior to the price increase in the quarters of 2010 and the first quarter of 2011. So during the first year after the price increase, the firm's stock price, which is just a measure of future expectations, it fell from about $33.60 per share down to just $7.80 per share. By the end of 2016, though, that stock price was back up to $123 per share. By the end of 2021, it was just over $600 per share, and they'd grown to 214 million subscribers in over 50 countries globally. Now, at the time of recording in 2015, it's 283 million global subscribers, and it's trading at $1,058. So a lot has changed since they did those initial price increases. And we have officially declared Netflix as the winner of the streaming wars. So no surprise as far as the stock price goes there. But I want to return to the question of what happened, because obviously the Netflix officials understood the law of demand. They actually reported that when they announced the price increase, that they thought they would lose about 600,000 subscribers, and you can see how they calculated that they thought that demand would be inelastic based on the estimate of $600,000. They thought elasticity would be 0.05, so very inelastic. But what happened was 810,000 subscribers left and their stock price tanked. Obviously, they've rebounded, but at that time, it was brought into question. So why was the estimate so far off by 25%? In the more than 2 decades since Netflix had been founded, there was an increase in the number of close but not perfect substitutes, right? Consumers had a lot more choices. They had Vudu and Amazon Prime and Hulu and Redbox. You could also still go to Blockbuster for a time there, but they weren't the exact same. So, there were some substitutes. They weren't the best, but they did exist. What missteps did the management take when they made this decision? Well, they misjudged the elasticity of demand by about 25%, right? They thought it would be 600,000 lost subscribers and ended up being 810,000. So they failed to account for those substitute services that were available. And it seems they may have also misjudged customers' preferences and their tastes. However, right, the very substantial increase over time, over the long term, actually shows that the number of Netflix subscribers that preferred the streaming services, the streaming video, well overtook the preference for the physical DVDs. And that was what really changed the equation for Netflix. It wasn't so much because of the pricing, it was because of the change in consumer preferences. So over the long term, they came out ahead, not because of the price increase, but because of the shift in consumer preferences. Their price increase was still a misjudgment. So to wrap up our chapter on elasticity, I want you to remember elasticity, it's all about decision-making. It's about decision-making for governments and how they can help balance, whatever their public health objectives are with the tax revenues that they want to generate. For companies, it's elasticity helps us to optimize our pricing strategies to help balance profit and total revenue and demand for our products. Understanding elasticity helps to anticipate what the consumers will do and what the producers will do in response to those changes in price. And it provides a really versatile framework for analyzing responsiveness in markets, not just about price, but also based on income and related products with the cross-price elasticities. All of that is helping to inform policy decisions and our pricing. Elasticities in labor and financial markets are also highlighting the behavior in those non-traditional markets. So that's going to conclude our discussion of elasticity. That's going to wrap up this chapter. I think in the next chapter, we're looking at, I can't remember. We're looking at consumer choices. So I will see you all in that one. Thanks a lot.